Imagine for a second looking at a business that just burned through $4 billion in cash. I mean, it's flashing warning sirens across every single technical indicator on Wall Street.
Right, and you have historical data showing its own executives quietly selling off their shares.
Exactly. Now imagine that despite all of that, top analysts are pounding the table. They are screaming at you to buy it, claiming it's actually, deeply undervalued. That is the exact paradox of Nebius Group N.V, ticker symbol NBIS.
It's just a historic contradiction. I mean, you have charts indicating that a severe pullback is long overdue, while the fundamental corporate backlog suggests the growth story is, well, it's only in its first inning.
Okay, so let's unpack this. Our mission for today's deep dive is to figure out if this company is the definitive AI infrastructure play of the decade, or if it's basically a perfectly disguised value trap waiting to spring on retail traders who buy at the top.
Which happens way too often, unfortunately.
Yeah, it really does. And speaking of missions, if you enjoy deep dives that cut through the Wall Street noise to uncover what is actually happening behind the scenes, hit that subscribe button, like the video, and definitely let us know your take in the comments below. We rely on your feedback to keep these deep dives coming.
And just to establish our parameters right out of the gate here,
Right.
what we are doing today is just a natural human debate about market mechanics, dissecting the sources and the data. This is absolutely not financial advice.
Right. We explore the information and you make your own decisions. So NBIS is currently trading at $165.34. If you pull up the chart, it is an absolute parabolic rocket ship.
Oh, yeah.
I mean, it's up from a 52-week low of just $20.25. To understand how a stock climbs that high that fast, we have to look at the foundational catalysts, right? The specific deals that lit the fuse.
Well, we aren't talking about small, speculative pilot programs here.
Yeah.
We're looking at foundational enterprise AI infrastructure deals. The cornerstone of this run is Meta.
Right, the $27 billion contract.
Exactly. Nebius secured a $27 billion 5-year contract to provide Meta with dedicated AI capacity utilizing NVIDIA clusters.
$27 billion from one single client. I mean, that is the kind of revenue backlog that entire mid-cap indices would envy.
Yeah, and they followed that up almost immediately with a Microsoft deal. Analysts estimate that one to be worth anywhere between $17.4 billion and $19.4 billion.
Wow.
Providing dedicated AI capacity on this scale, it means building custom, specialized computing environments that these tech titans can simply plug into,
Right.
rather than having to source and cool the hardware themselves.
And the hardware sourcing is the crucial part, right? Because the sources highlight that NVIDIA has thrown its strategic backing behind Nebius.
Yeah, which is massive.
It is. Here's where it gets really interesting. In the current landscape, getting your hands on top-tier GPUs is the single biggest bottleneck in the entire AI industry. If you don't have NVIDIA's blessing, you basically wait in line for 18 months, and your multi-billion-dollar contracts just die on the vine.
Exactly. That strategic relationship grants Nebius vital, early access to restricted hardware. The computing clusters required for the Meta and Microsoft deals, they rely on highly specific networking architecture.
Like InfiniBand and NVLink. Right.
Right, stuff that only NVIDIA can provide at this scale. Without priority access to that hardware, Nebius just couldn't fulfill a fraction of those contracts.
So securing tens of billions in contracts makes for incredible headlines. But I want to move from the press releases to the actual income statement. Let's look under the hood because the financial engine driving this company is incredibly complex.
Oh, it's the ultimate story of explosive top-line growth colliding with heavy systemic operational spending. If you compare the fiscal year 2025 to 2024, the revenue explosion is just staggering.
Yeah, they jumped from $117.5 million in FY24 to $529.8 million in FY25.
A 350% jump in revenue. And it pushed their net income into positive territory. They flipped from a $641.4 million loss in FY24 to a positive $101.7 million in net income for FY25.
Right, and on the surface, if you just read those two lines, it looks like a total victory.
But then you see they posted a negative operating loss of $596.2 million for FY25.
Wait, hold on. They grew top-line revenue by 350%, flipped their net income positive, but still lost over $500 million operating the business. I mean, where exactly is the leak in the bucket here?
Well, if you look at just the fourth quarter of FY25, it gets even stranger.
How so?
They posted an earnings loss of $249.6 million on $227.7 million in revenue.
So they literally lost more money than they brought in during that specific quarter. How does the accounting even work there?
It really comes down to aggressive scaling and heavy depreciation. When a company purchases tens of thousands of incredibly expensive GPU clusters to service these mega contracts, well, that hardware becomes obsolete rapidly.
Right, the tech moves so fast.
Exactly. So the accounting rules require them to front-load the cost of those GPUs as depreciation. So while they might be generating cash, the sheer depreciation of the hardware drags their operating income deep into the red.
Okay, let's talk about the balance sheet for the most recent quarter then, because the actual cash position tells another story entirely. Total assets are sitting at $12.45 billion against $7.84 billion in liabilities.
Which is a solid ratio.
Yeah. And they also have a war chest of about $3.68 billion in cash, bolstered by recent capital raises.
And they need every single penny of that cash pile. If you look at their cash flow statement, they generated a positive operating cash flow of $384.8 million.
But the CapEx,
Right, their capital expenditures, the CapEx, is an astonishing negative $4.07 billion.
which brings us to a metric that is crucial for understanding this company's survival, which is levered free cash flow. The sources show a levered free cash flow of negative $3.61 billion.
Yeah.
For anyone not steeped in financial modeling, levered free cash flow is basically the amount of cash a business has left over after it meets all its financial obligations, like debt payments. And negative $3.61 billion means they are entirely dependent on outside financing just to keep the lights on and keep building.
Building physical data centers it's extraordinarily capital intensive. You're talking about immense amounts of concrete, industrial cooling systems, specialized power grids.
Copper wiring, right. All before you even install a single computer chip.
Exactly. That $4 billion in negative CapEx is just the unavoidable cost of doing business in bleeding-edge AI infrastructure.
Yeah.
You cannot service a meta contract of that size without physical, power-hungry real estate.
So what does this all mean? They have unprecedented revenue growth, but they are bleeding billions in free cash flow to build these centers. You'd think a cash burn that severe would terrify investors, but when you look at the price chart, buyers are absolutely swarming it.
They are.
What is the chart telling us that the income statement isn't?
Well, the chart reflects the market pricing and future dominance rather than present cost. The latest market quote is $165.34. That is pressing right up against its 52-week high of $168.71.
And the medium to long-term trend direction is undeniably bullish.
Absolutely. The moving averages are trailing so far behind the current price that it looks like a rubber band stretched to its absolute limit.
Yeah, the price is well above the 50-day moving average, which sits at $108.90. And it is light years ahead of the 200-day moving average at $93.30.
We also see the MCD, the moving average divergence, sitting at roughly 4.6 to 5.8.
And that isn't just a random number, right?
No, the MCD measures the speed of the current trend against its historical average. That positive spread confirms the upward momentum is incredibly strong, almost unhinged from historical norms right now.
Which brings us to the weakness signals. The 14-day RSI, the Relative Strength Index, is ranging from 72.93 to 76.42. For anyone following along, an RSI over 70 places the stock firmly in overbought territory.
Right. It implies that buyer exhaustion is imminent.
A high RSI indicates the momentum is unnatural and unsustainable without a breather, doesn't it?
Yeah, a short-term pullback or a period of sideways consolidation is technically overdue, just so the market can digest these rapid gains. If it does pull back, the key support levels to watch are $97.88, then down to 83.52, and finally a floor around 75.45.
And on the upside.
On the upside, the key resistance is that 52-week high of 168.71. Breaking that could push it toward the $173 to $180 pivot levels.
Okay. Here is where the technical data meets human psychology. Let's look at the order flow. Who is actually buying and selling the stock right now?
That's the real question.
The sources note significant institutional block accumulation occurring near the $145 to $150 psychological barrier. So big money is absorbing shares in the 140s. Meanwhile, retail traders are the ones actively buying and taking profits at the 165 plus heights.
You also have to factor in the historical insider activity. Because Nebius operates as a foreign private issuer, and FPI SEC Form 4 tracking is less transparent than a standard U.S.-based company.
Right.
But the historical data we do have shows executive sales happening between $98 and $161 during this entire run-up.
So, If the RSI is screaming that the stock is overextended and insiders were selling on the way up, while institutions quietly accumulate in block trades lower down, is this a scenario where retail traders buying the breakout today at 165 are walking straight into a trap?
It is the classic structural dilemma of the stock market. Institutions buy the foundational thesis, often absorbing shares during periods of weakness or consolidation. Retail traders, they often buy the momentum and the headline.
The hype, basically.
Exactly. If a retail trader buys at 165, expecting it to hit 200 by Friday, and the stock takes an overdue technical breather down to 110 to test its 50-day moving average, that trader's going to panic and feel trapped.
Even if the long-term multi-year thesis hasn't changed a single bit.
Precisely.
Which transitions us to the debate splitting Wall Street right now. Is Nebius an undervalued utility or a complete value trap? Looking at the analyst consensus, Wall Street is surprisingly unified on the direction. 55% have it as a strong buy and 36% have it as a buy.
The price targets reflect that heavy optimism too. The median target has struggled to keep pace with the explosive price action, but the high-tier estimates are projecting anywhere from $211 to $291 per share.
But beneath those buy ratings, the valuation debate is incredibly polarized. Let's start with the bear case. The bears argue this stock is severely overvalued, pointing to a trailing P/E ratio, price to earnings above 1,400.
Yeah, 1,400.
1,400. They also point to a highly inflated price to sales ratio.
From a traditional software valuation standpoint, a PE of 1,400 is stratospheric. I mean, it implies an investor is paying an unbelievable premium for every single dollar of current earnings.
But the bull case argues that applying software metrics to this company is a fundamental misunderstanding of their business model, right?
Right. The value bulls say you have to back out their $3.68 billion cash pile and then account for the $27 billion in contracted backlogs.
Mm.
If you do that, they argue Nebius is fundamentally an undervalued utility with a built-in safety margin.
Utility is the critical concept here. Nebius is publicly targeting 2.5 gigawatts of power capacity. They are shifting their core identity from being a standard tech stock to becoming essential power and compute infrastructure.
Exactly. Valuing Nebius like a software company is, well, it's like valuing a hydroelectric dam based on how much water is currently in the river.
That's a great analogy. You aren't buying the water, you are buying the concrete wall that guarantees they control the flow of that river for the next 30 years. Power plants require billions in upfront capex, but they generate guaranteed contracted revenue for decades.
And let's put 2.5 gigawatts into perspective. That is an astonishing amount of electricity. It's equivalent to the output of a nuclear reactor, capable of powering millions of homes.
Wow.
Securing that kind of capacity requires years of lobbying, grid upgrades, and securing physical real estate. If you lock down 2.5 gigawatts of capacity and have clients like Meta and Microsoft locked in for 5-year terms, you aren't fighting for software subscriptions month to month. You are an indispensable utility grid for the AI economy.
But if it is truly a guaranteed utility with top-tier backing from NVIDIA and ironclad contracts, why is there any hesitation from the bears? I mean, nothing in the market is guaranteed. Let's look at the dark clouds threatening the long-term outlook. What is the bear case downside scenario?
The downside risks are severe, and they really cannot be ignored. First and foremost is equity dilution.
Right.
The company recently raised over $4 billion in convertible notes.
Okay, let's break down how that works mechanically for anyone listening. Convertible notes are essentially debt that can be turned into equity, into shares of the company at a later date.
Right, and when those notes convert, the company issues new shares to the debt holders.
Right.
That waters down the value of the existing shares.
So your slice of the pie gets smaller.
Exactly. And if the stock price struggles, the terms of those notes sometimes dictate that the debt holders receive an even greater number of shares to compensate. That $4 billion in convertible notes could cause heavy equity dilution for current retail shareholders later on.
You might own a slice of a growing pie, but your specific slice just got paper thin.
Well put.
And the second major risk is operational bottlenecks. We discussed how NVIDIA put them at the front of the hardware line, but scaling massive physical data centers and actually getting physical delivery of restricted bleeding-edge chips are immense hurdles.
Yeah, if the global supply chain chokes, they cannot build the data centers. And if they can't build the data centers, they simply cannot service the Meta contracts.
Which leads directly to a third risk, highly unique to Nebius, which is geopolitical volatility. Nebius is the former international arm of the Russian tech giant Yandex.
Right.
While they have formally spun off to protect their international operations and establish themselves as a European entity, their historical lineage and global footprint leave them vulnerable to sudden geopolitical shocks.
Because sanctions and international trade policies are incredibly fickle right now. An overnight policy shift in Washington or Brussels could potentially complicate their ability to import U.S.-made chips or secure international financing.
So, can a sudden geopolitical shock or a physical supply chain bottleneck completely derail a $27 billion contract?
It can absolutely delay it.
Yeah.
And in a market that is pricing in flawless execution with a PE of 1400, delay is deadly.
Yeah, I bet.
If Meta expects a computing cluster online by the third quarter and a specialized cooling equipment bottleneck pushes that timeline to next year, the market will aggressively reprice the stock downwards. The contracts themselves might be secure, but the timeline to recognize that revenue is entirely at the mercy of the physical supply chain.
So, weighing those existential risks against the multi-billion-dollar contracts with Meta and Microsoft, what is the actual trajectory of this stock moving forward? What is the short-term versus long-term outlook?
We really have to analyze the outlook across those two distinct timeframes.
Yep.
In the short term, those overbought technicals, the high RSI, the price stretch so far beyond historical moving averages, they suggest intense volatility ahead.
Right.
The stock is technically overdue for a pullback or a period of sideways consolidation just to digest the recent rapid gains.
Which means if you are tracking the stock over the next few weeks, it could be an incredibly bumpy ride, especially around those key support levels we mentioned earlier.
Exactly. But in the medium to long term, the best case recovery and growth scenario depends entirely on execution. If Nebius can successfully navigate the supply chain, convert their 2.5 gigawatt power capacity target into active data centers, and fulfill those mega contracts well, the multi-year trajectory remains historically robust.
And the worst-case bear scenario.
The worst-case scenario is a rapid continuation lower. Imagine if that convertible debt dilution hits the market right at the exact moment. A geopolitical shock or a supply bottleneck delays their data center buildouts.
Oh, man.
You would have a flooded float of new shares fighting for delayed earnings. That is how a high-flying stock collapses and traps investors.
It really is a staggering contrast at the heart of this company. On one side, you have 350% top-line revenue growth, NVIDIA's golden backing, and historic multi-billion-dollar AI contracts with two of the biggest tech companies on Earth. And on the other side, you are battling extreme 1,400 PE valuations, capital expenditures burning through $4 billion, and very real looming dilution and supply chain risks.
It is the defining battle of the AI infrastructure boom right now. It requires a tremendous amount of critical thinking from anyone following this space, separating the headline momentum from the operational reality.
Absolutely. And as a final reminder, this deep dive is an exploration of the facts, the SEC filings, and the technical charts. It is not financial advice. We just want to give you the clearest, most detailed picture possible of what is actually happening beneath the surface.
The data provides the roadmap, but understanding the mechanisms behind the numbers is the true challenge.
And that brings us to the end of our deep dive today. But we want to leave you with a final thought to mull over. If the true ultimate bottleneck for the future of AI isn't the software or even the chips themselves, but the literal electricity and physical infrastructure required to run them, is Nebius building the indispensable utility grid of tomorrow? Or are we just looking at the most expensive $4 billion bonfire of investor cash we've ever seen? Let us know what you think in the comments.